All right, today we are cracking the code on a really important but kind of complex topic for any Canadian business owner: associated corporations. If you want to make sure you're setting up your business for maximum tax efficiency, you are in exactly the right place. Let's just start with a number: $500,000. So, why this number? Well, because it represents a huge opportunity for Canadian businesses. But it also comes with this whole web of rules designed to limit how you can use it. So that $500,000, that's the magic number for something called the Small Business Deduction, or the SBD. Think of it as a massive tax incentive that dramatically lowers the tax rate on your first $500,000 of profit every single year. And that means more cash left in your company to grow, hire, and expand. Now, that brings up a pretty logical question, right? If your business is doing great and you're hitting that limit, why not just, spin up a second company? Or a third? Get another $500,000 limit for each one. It's a clever thought for sure, but the government is way ahead of you on that one. So here's the game plan for today. We'll quickly go over the incentive, then we'll get into the association rulebook, define what control really means, look at how to structure for success, and then we'll wrap it all up with the key takeaways.
So let's get right into it. The Association Rulebook. This is basically the government's entire playbook for stopping businesses from multiplying that amazing tax break.
The rule in principle is actually pretty simple. If the Canada Revenue Agency, the CRA, decides that two or more of your companies are associated, they don't each get their own 500 grand limit. Nope. Instead, they're forced to share one single limit between them. And just like that, the whole strategy of creating more companies for more tax breaks, it's gone. So this is the most important thing to get your head around. The entire concept, this whole rulebook, it all hinges on one single word: control. If you can understand what the CRA means by control, you can understand all of this. It is the absolute key.
Which brings us to our next section, the meaning of control. And you're about to see that control is so much more than just who owns the most shares. The definition is incredibly broad, and it's designed that way on purpose to catch a huge variety of business structures.
So there's the obvious one: legal control. That just means owning more than 50% of the voting shares. Simple enough. But then there's control in fact. This is where it gets murky. It's the ability to have significant influence even if you don't own the majority. And it doesn't stop there. You've got indirect control through other companies and group control where, get this, you can be part of a controlling group with just a single share. You can see how this gets complicated fast. Okay, so let's get into the weeds. The Income Tax Act actually lays out 5 main rules that determine if companies are associated. We're going to walk through each one, and I promise, we'll use clear examples so it all makes sense. Rule number 1 is the most direct one, which is nice. It's simply when one corporation controls another one. This is your classic parent company subsidiary relationship. But what's really crucial here is how this creates a chain reaction. If Corp A controls Corp B, and B in turn controls Corp C, it's not just about the direct links. The rules say that A is also associated with C. Why? Because of that indirect control it has through its ownership of B. It's like a domino effect. All right, next up is Rule 2. This one happens when two totally different corporations are controlled by the very same person, or by the very same group of people. This one's pretty easy to wrap your head around. If you, as one individual, own a controlling stake in two separate companies, well, they're associated. Same logic applies if a specific group, say you and your business partner, together control two separate companies. Those two are also associated. Okay, now we're getting into family ties. Rule 3 is all about control by related persons, like, say, a mother and her son. Now, this rule has a very important catch. It's not enough for you to control one company and for your son to control another. For them to be considered associated, one of you must also own at least 25% of some class of shares in the other person's company. It's this cross-ownership that creates the link in the CRA's eyes. Building on that idea, Rule 4 gets a little bit more complex. This is a situation where one person controls a company and a group of their relatives controls another company. So let's break this down. You control your company, Corp A. A group of your relatives, maybe your siblings, controls Corp B. For these two companies to be associated, you have to be related to every single person in that controlling group. And on top of that, you personally have to own at least 25% of their company, Corp B. And finally, we have Rule 5, which is definitely the most complex of the bunch. This is where two separate but related groups of people each control a different corporation. Okay, stick with me here. You've got one related group controlling Corp A and another related group controlling Corp B. For them to be associated, a bunch of things need to be true. First, every member of the first group has to be related to every member of the second group. And then there has to be at least one person who is a member of both of those groups and who owns at least 25% of both companies. I know, it's a high bar, but it exists to catch really complex family business setups. Okay, phew, that was a lot of theory. So now let's bring it all back down to earth. Section 4, Structuring for Success. Why does any of this matter in the real world? Let's see how these rules affect a really common decision: expansion.
This slide shows you everything you need to know. In Structure 1, your company owns 60% of a new venture. That is control, plain and simple. So the companies are associated, and they have to share one SBD limit. This means the new company's profit gets taxed at a much higher rate. But now look at Structure 2. You bring in a partner, and you each own exactly 50%. Now neither of you has control. The companies are not associated, and they each get their own full $500,000 SBD limit. That one simple change in ownership dramatically boosts the new venture's cash flow. It's a total game changer.
So, what are the big takeaways here? First, that small business deduction is an amazing tool worth protecting. Second, the whole reason these association rules exist is to prevent people from multiplying that break. Third, control is the name of the game, and its definition is super broad. And maybe most importantly, how you structure your business expansion has huge tax consequences. A little smart planning up front can mean a lot more cash in the bank and a better shot at success. So I'll leave you with a final question for your own business. As you grow, as you start new ventures, are you consciously building a structure that maximizes its potential? Or are you building one that's accidentally leaving a whole lot of money on the table? The answer could have a massive impact on your bottom line.